welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First up, earnings season in full swing. We'll bring you the movers you need to know. Plus, speaking of which, General Motors is raising its outlook as truck demand offsets tariff headwinds. We'll have full coverage ahead. And we'll sit down with the president and CFO of Coca-Cola as that company tops earnings estimates. All that and more coming up on Market Catalyst. But we start taking a look at the major averages here this morning. We see a mixed picture. Now, I mentioned this earlier that during earnings season, unless you have something large and thematic or a big dominant reporter like some of the big tech companies, you tend to see stocks sort of overall not necessarily move as much, and that's the case today. The Dow is up by about 44 points. The S&P 500, though, down slightly, and the Nasdaq Composite is off by about 0.3%. And to illustrate why this is, you can look, for example, at the Nasdaq 100, which is quite mixed today. Not a lot of companies here are reporting earnings, by the way. Tech really gets underway more in earnest next week, but we're seeing a little bit of bouncing around here. Apple, in particular, we continue to watch the sort of market cap increases in Apple. We're looking for it to cross that $4 trillion market cap threshold. It's getting close to that threshold. Still likely going to be a little bit smaller than Nvidia, however. But if we get into the Dow and look at some of the movers there, and I'm going to just equal weight it for purposes of being able to see this a little bit more easily, you see here more clearly what's going on with the earnings picture, right? So you have, for example, Coke, which is up by nearly 4% following its earnings. 3M up on its earnings as well. It's up about 2.5%. So there's some of the earnings movers that we are watching in today's session. And then we get into some of the industrials and elsewhere as we watch what's going on earnings-wise as well, and of course GM, et cetera. So kind of more of a mixed picture with these individual earnings movers that we continue to watch. And let's talk a little bit more about one of those movers. We're talking about General Motors. GM shares jumping after it lifted its full-year outlook and topped Wall Street's profit estimates in the latest quarter. The automaker forecasting a smaller hit from tariff exposure than previously estimated. Joining me now, fresh from GM's earnings call with some of his key takeaways, Yahoo Finance senior autos reporter Pras Subramanian. And so, Pras, what is sort of the big overall takeaway from GM?
Yeah, it's really about that guidance, the beat. Yeah, they did have strong Q3 earnings, but also it's just the guidance, the beats, the raises there, right? So you've seen full year EBIT range now 12 to 13 billion, adjusted automotive free cash flow of 10 to 11 billion, diluted adjusted EPS of 9.75 to 10.5. Those are all raises there compared to their guidance in the spring. So really kind of that's what we're seeing the stock move here, really sort of investors getting bullish on GM's kind of forward-looking outlook for 2025. Now tariffs, you mentioned tariffs. GM narrowed its full year tariff costs to 3.5 to 4.5 billion. Prior to that was 4 to 5 billion. And this quarter, they took about a $1.1 billion hit from tariffs, which is about what they did last quarter. So Mary Barra said in her letter to investors that, quote, I also want to thank the president and his team for the important tariff updates they made on Friday. Now, what she's talking about is this MSRP offset program where you can offset the costs of some of these tariffs from the vehicles you make in the U.S. by about 3.5% of the value there. Also, they got more relief in the terms of some auto parts and metals tariffs coming down a little bit, so that helped them a lot. So yeah, stock charging higher, much higher here right now.
Yeah.
Early in the day.
Let's also talk about the EV business, because GM did some restructuring of that business.
Yeah.
What do we learn about today with the demand for the cars looks like? Like, what's the progress of all of that?
So last week, I don't think it was a surprise. They took a charge of about $1.6 billion to their EV business, some non-cash stuff and some cash stuff, to reassess their business, to deal with some of the factory overcapacity they had, and then also pay off some suppliers they had to take care of because they weren't going to make as many EVs as they thought. And then they said that recently that in October, EV sales were down considerably, but they think that next year they'll see this natural demand, quote unquote natural demand of what EV demand is in this country without the incentives, right? So one thing in the call that came out, Mary Barra talked about how the company decided to wind down the BrightDrop EV delivery van business, which was a thing that they were very bullish on only a couple of years ago. I actually had the chance to drive this at an event in Brooklyn. It was a really interesting van. Picture a big FedEx van, basically. It's all electric. They're going to wind that down because apparently, reportedly, a lot of these vehicles on lots in Michigan and Canada. It's built in Canada, which also might be an issue too. So a retrenchment there. They're still bullish. Mary Barra called it, still EVs are their North Star, right, for the future of the company. So it's just, but she also said ICE vehicles are going to be here for longer. So
interesting. Trying to do all the things at once.
I think that's really kind of how do you do all the things, right?
Yeah. All right, Pras, thanks a lot. Appreciate it. We're going to dig more into this right now. Joining with an analyst take on GM's third quarter results and full year guidance is Michael Ward, Citi Research Managing Director. Michael, it's good to talk to you. I thought your note was so interesting because you talked about GM as an enormous ship. And in the past, it's been tough to turn that ship. But you say they're getting a little bit better at doing it. So how are they getting more nimble at GM?
Thank you and good morning. Thank you for having me. I've been following GM for over 40 years, and it used to be used as a crutch, as an excuse. It takes a long time to turn a big ship. You go back to the late 70s, early 80s with some of the gas shocks. It took GM over a decade to adjust its product lineup. You look at the events that took place this year between changing the EV incentive and the tariffs. They've adjusted it in 6 months. That's a staggering change from the GM culture of the past. And so when I look at GM, a lot of it started with what happened in 2008 and the restructuring. They lowered the break-even level 50%. And quite frankly, I think Paul Jacobson's the best CFO to be in Detroit that I can remember. And he's got the entire organization reacting and acting incredibly fast, and that's led to cash savings. It's led to operating savings, and you've seen it translate into better performance at General Motors and better positioned to capture some of an improving cycle, in my opinion.
And so where does GM go from here? Not only, so operationally, as you've discussed, they've been more nimble. There's only so much they can do about end market demand, but how are those trends going to evolve?
Well, they've gained share in the U.S. in each of the last 3 years. They're up about a point year to date this year. If you become more nimble and you can get product to market faster that consumers want to buy, because normally the product development life cycle historically has been 3 to 5 years. If you can make those adjustments faster than the rest of the market, you're going to have the best product in the market. You're going to be able to get the best price. Right now, their ATPs are about $3,000 to $4,000 above the market, and their incentives are $2,000 lower. So they're getting better price on better products, and it's translating to higher market share.
Talk to me about tariffs for a second here, because obviously Mary Barra talked about some of the negotiating that they did with the administration, or some of the concessions perhaps that they got from the administration. But what are they also doing? I mean, it's not like they're not taking any hit from tariffs. They're still taking a hit. But what's your assessment of how they're managing all of that?
Well, I think when they first came out and they said the tariff hit would be roughly $4 to $5 billion for 9 months this year, everybody stepped back, and they said they'd be able to mitigate about 30% of it. Since that time, they've mitigated 35%, and the tariff impact has been lowered because of some of the changes that have taken place. And when the Korean deal gets signed, that will lower them even further. If we get progress with Canada and Mexico, you could get to a point that by the end of 26, that initial $4 to $5 billion or $6 billion annualized is entirely offset. I think you have to give a lot of credit to the GM senior management, Mary Barra in particular, and others within the industry. They've had a lot of back and forth and communication with DC, and DC has been able to help them in that regard. That comes from communication. If GM had stepped back and whined and moaned and said, this is ridiculous, we can't possibly compete with this, I'm guessing that the administration would have pushed back. They didn't. And they communicated, and you tip your hat to Mary Barra and the rest of her team for having a good communication, a good dialogue with Washington, and they've been able to make some adjustments where now it sounds like most of that impact is going to be mitigated by the end of next year, and suddenly, the company is more competitive and our U.S. economy is more competitive.
And Michael, I was just talking with Pras about the EV business, and I'm curious to get your take specifically on that. He said also that the company is sort of taking the approach that they won't get a real read on what they call the natural demand for EVs until next year, when all of these things, the incentives, non-incentives, kind of calms down. What do you think the natural demand for EVs is?
Well, I think, first of all, you go back to the early 1900s, and EVs were over 1/3 of the U.S. market. So that's a historical perspective. For decades, they had EVs that nobody wanted to buy. And certainly Tesla introduced that to the market, that if you have the right vehicle, people will buy it. EVs come down to a use case. if you talk to people that own an EV, no matter where they are, whether they're California or the Northeast, once they have one, they're not going back. And so to me, I've always wondered why, if EVs are that great, why do you need a $7,500 incentive? And so now we're going to find out. I think, EVs, if you take the old rule that California trends lead the rest of the country, California's at 20% EVs. That's my guess where we're going, 20 to 30%. Now, I think the government was trying to force it that it would be in 5 years. Realistically, it's probably 15 to 20. So by the time you get to the mid-decade, in 2035, in that time period, I would expect EVs to be somewhere in that 25 to 30% of the U.S. market. And again, it's all a use case, and people that have them love them. And so I think that will continue.
Do you think that GM will end up being a dominant player there? I mean, I know that's a little bit far away to be able to tell now, but who do you think, or is it still Tesla's game to lose?
Tesla has the strongest brand name. GM has the broadest products. And so GM also has the broadest service and distribution. The auto business is a service and distribution model. That's what it comes down to. And the strongest asset they have is that dealer base that can distribute and service the vehicles throughout the country. And so, yes, GM is going to be a leader. Now, is that 1/3 of the market? Is it 25% of the market? That's anyone's guess. My guess is it'll continue to be very competitive. The Chinese-based manufacturers will enter the U.S. market at some point. They have extremely competitive products at lower cost. And so that's going to be a competitive dynamic as well. So I think as you look at it today, GM once again has best distribution, the most broad product, range of products that they can offer. They're going to be a major competitor in the EV business in the next 5 to 10 years.
Michael, thank you so much. Really interesting stuff on GM and the whole auto business. Thank you.
Thank you very much for having me. Appreciate it.
All your markets action coming up, including the top trending tickers on Wall Street. You're watching Market Catalysts. We'll get a check of the pulse of the economy on Friday as the Labor Department is expected to release September Consumer Price Index data. It's the first batch of government inflation data released since the start of the shutdown. It could ripple across the economy and the markets. I'm joined here on set by Stephanie Roth, Wolfe Research Chief Economist, and Collin Martin, Schwab Center for Financial Research Fixed Income Strategist. Guys, it's been so quiet. We haven't had any of this government data. So finally, we're going to get CPI on Friday, Stephanie. What are you looking for?
So we are forecasting 0.26 on core. Our expectation is it should be kind of a non-event type of reading, certainly lower than what it could have been given the extent of the tariffs. We should have goods prices be a little bit firmer. We're expecting rent and OER to disinflate a little bit further from where we were. So net, it's kind of a boring print that puts core PCE at 0.23.
Don't say that.
I know. The labor market data we're excited to get. We just don't know when we're getting it.
I mean, it's so interesting on the inflation front because we're also in the thick of earnings season. We have lots of companies now, GM being the latest example we were just talking about, that's saying, yes, we're paying a lot of tariffs, but we're not paying the worst case scenario of tariffs. And I guess, Collin, that's something that shows up in the macro data too.
Yeah, I mean, things are generally okay. There was this big fear about what would happen with those tariffs. I mean, obviously the numbers have bounced around a lot, but here we are, months into this, and the consumer is still strong. Companies are saying they're paying some of them, absorbing some of those costs, but earnings have been generally okay. We're not really seeing it impact, take a hit to the economy. Obviously, Stephanie's going to look at more of that than I do, but so far things are okay. And I think that's something that the Fed is grappling with. If we go back 6 months, they were more worried about inflation and how that's going to play into it. But we're hearing more officials now talk about it's probably going to be less of an impact than they were initially penciling in.
So I know there is a lot of optimism out there. I want to look at the other side of the equation. And, a lot of folks have brought up things like auto delinquencies lately. Of course, we also had the troubles at Tricolor and First Brands, which again relates back to autos and lending. How concerned, Stephanie, are you about some of those signals?
I think it's largely idiosyncratic. So we have some of the issues related to autos, but also complex financing. Then you've had some other negative credit events, but that seems to be tied to fraud and commercial real estate. It truly does appear to be idiosyncratic events. They just happen to all be coming together at a point where everybody's a little uncertain. But generally speaking, delinquencies have been edging down outside of a little bit of subprime auto. The consumer seems to be largely fine. I think we're in an environment where the economy will hold up and then actually inflect higher for next year. I think that's where we're a bit more out of consensus that the risk is that growth surprises to the upside in 2026 as opposed to the opposite.
Where does that growth come from?
Couple things. One, we have fading tariff uncertainty. Of course, the headlines are still out there, but we now know the president isn't intending to put us into recession. On top of that, financial conditions have eased. And then another thing that's perhaps underappreciated is foreign direct investment, some of the promises that have come to the administration. Now, the administration has promised, or they've been tracking about $8.8 trillion worth of investment. That's not happening. But Japan, Korea, some of those investment pledges may actually come into fruition, which could boost GDP by about 20 basis points next year.
And then I also want to talk a little bit about the bond market, specifically with you, Collin, because that's what you look at. We've been seeing yields push below 4%. Christopher Waller, of all people, came out recently and he said he's not sure they're going to cut 2 more times this year, although the next one seems pretty assured. So do you think the market has gotten too complacent pricing in 2 more cuts?
I do. When I saw that quote, it was music to my ears because that's kind of been our view for a while. And I think talking about Waller is really important because he's been one of the more dovish committee members out there. And he said beyond October, it's a really uncertain outlook. And that's kind of where we stand. Things are pretty good right now. We're not sure how weak the labor market actually is. We need to get the data, of course. We're kind of in this data void right now. But inflation's still high. And if I can piggyback on your points, if the economy is doing pretty well, we struggle to see how much inflation is going to come down. I think there's enough concern with the Federal Open Market Committee to cut rates as much as the markets are expecting right now. So our outlook for this year, we say 1 or 2. It's very vague. It's more open-ended. But when we look at that, aggressive path of rate cuts next year, I think sub 3% by September, that just seems too aggressive given what we see right now. Given that the economy is still doing pretty well, the second quarter ended up being a nice quarter, especially on the consumption side, and inflation's still too sticky. So we think the markets are being a little bit ahead of themselves, getting ahead of themselves in terms of the aggressive path of rate cuts.
Do you agree? I mean, if your scenario is correct and we're going to inflect higher, that also might suggest that the Fed can't be as aggressive.
Yeah, I think that's totally right. That we're in an environment where the market is just aggressive on the Fed cuts. And we're in a place where inflation is still, even though it's not as bad as it could be, inflation is still running at 3%. And it's probably going to get stuck around 2.5%, which is still not 2%. So if the environment actually inflects higher with growth running above trend, so somewhere above 2%, and inflation is sticky at 2.5 to 3, it's hard for the Fed to cut as much as what's in the price.
Julie, can I don't want to throw too much cold water on this discussion. This is nice right now. But we're a little bit more concerned about those credit issues. Everyone throws out idiosyncratic. I think David Solomon mentioned it with the regional banks. Our concern is that there have been cracks under the surface that just haven't made the big headlines that First Brands and Tricolor have made. I mean, these are big ones. We're talking billions of dollars. When we look at defaults, though, from Moody's and S&P, they publish their default rates. We've seen default rates at 4% or more for almost 2 years now. We just don't hear about it because it's not the big Chapter 7s, Chapter 11s that are grabbing the headlines. It's a lot of distressed exchanges, a lot of liability management exercises, but those are defaults by definition, and they usually mean credit losses. So there have been these concerning issues below the surface. If it ends up being something bigger, is this the canary in the coal mine? We're not sure, but we have been a little bit concerned about the credit markets, especially from the valuation standpoint.
Well, and the other thing to me that's so fascinating is there seems to be pretty broad agreement that the consumer is okay. But when we say the consumer is okay, we don't really mean the consumer. We mean the consumer. These guys down here are not necessarily okay. But from a macro standpoint, I guess, when does it matter? Does it ever, how long can upper income support the economy overall, or is it indefinitely?
I mean, as of now, it's been stuck between the bottom 20 to 40% of income earners that have been sluggish. That will probably remain the case for a while. That said, heading into next year, a lot of the fiscal stimulus does benefit the lower end consumer. So we might see a pocket where they do a little bit better, but generally speaking, it doesn't matter a whole lot if the bulk of the economy is doing okay and those cracks don't actually materialize into anything more significant, which as of now, that has largely been the case. One challenge or thing to keep in mind is that equity wealth has helped to support some of this upper end consumer. So as long as equity markets continue to do well, then that narrative continues to play out. There's an environment where things start to snowball, but that's certainly not our base case.
Okay, well, we'll keep in touch in case all of that, and keep watching all of these things, and keep watching for more government data. Thanks so much, guys. Really appreciate it. All right, let's send it down to the NASDAQ now, where Ali Canal is standing by.
Hey, Julie. We're watching Meta, Starbucks, and Reddit in today's top analyst calls with fresh notes out from Bank of America, UBS, and Citi. Let's start with Meta. Bank of America reiterating its buy rating on the stock with a $900 price target, calling for another beat on both revenue and EPS when the company reports results next week. BofA expects Q3 sales of $50 billion and earnings of $7.30 a share, both above consensus, as Meta's AI-powered ad engine keeps firing on all cylinders. Analysts see 23% year-over-year ad growth. That's driven by better targeting, automation, and new AI creative tools, according to the firm. BofA also says that investors will be watching for updates on Meta's business AI platform and the return potential of its $600 billion U.S. investment plan through 2028. Next up, Starbucks. UBS is staying neutral on the coffee chain and trimming its price target to $94 a share. That's down from the prior $100, saying it's still waiting for sales to perk up. The firm expects flat U.S. same-store sales this quarter and operating margins around 10% as the company continues to pour money into labor and marketing tied to its Green Apron service model. UBS says the key question on the upcoming call will be whether management can lay out a timeline for a real turnaround in U.S. traffic and transactions. Finally, Reddit. Shares are higher after Citi added the stock to its positive 90-day catalyst watch, maintaining a buy rating and raising its price target to $250 from the prior $220. Analyst Ron Josie says he's upbeat on Reddit's growth and monetization plans, noting that partnerships with Google and Anthropic are boosting both traffic and revenue. Citi expects third quarter earnings on October 30th to come in significantly above expectations and says AI integrations like Reddit Answers could keep daily user growth above 20% through year end. Keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Galaxy Digital, Halliburton, and Hologic. First up is Galaxy Digital. Those shares are jumping after the company swung to a profit and revenue surged in the third quarter. The results boosted by momentum in its asset management and infrastructure solutions business. The crypto and data center company has benefited from a banner year for the digital asset industry overall. Tokens have hit new highs amid regulatory wins, and there's also been increasing corporate and institutional adoption of crypto. Next up, Halliburton. Third quarter net income fell sharply due to hefty impairment charges, but revenue did surpass Wall Street expectations despite a slide in the price of oil. The Houston oil giant posted earnings of $18 million or 2 cents a share, down from $571 million or 65 cents a share a year earlier. Last week, Halliburton's rival SLB posted a drop in quarterly earnings and revenue, citing a challenging environment. And finally, Hologic. Blackstone and TPG have agreed to acquire the medical diagnostics firm for more than $18 billion. It marks one of the largest healthcare take-private transactions this year. Under the agreement, Blackstone and TPG will pay $76 each in cash per share to acquire all outstanding Hologic shares. The deal expected to close in the first half of 2026. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we'll be talking to the Coca-Cola Company president and CFO about the company's latest quarter and how consumers are holding up amid economic uncertainty. Shares of Coca-Cola rising after the company reported earnings for the third quarter and reaffirmed full-year guidance. The company reported higher than expected earnings per share and total sales roughly in line with street estimates. For a closer look at this morning's report and what's ahead, John Murphy's joining us. He's Coca-Cola Company president and chief financial officer, and our Yahoo Finance senior reporter Brooke DePalma here as well. John, thanks so much for being here.
Good morning. Nice to be back.
So I'd like to talk a little bit about volume versus price, because it seems as though the sales increase was due largely to price increases. What does that tell you about customers' capacity to absorb those price increases? What are you seeing?
Yes, well, overall, we had a very solid quarter, and as you said, driven by good pricing and also good mix. You know, our pricing around the world is pretty much in line with inflation. And in this quarter, we saw the benefit of brands and categories where higher income consumers are engaged more with. Brands like Topo Chico, Fairlife, and Smartwater here in the US outperformed and gave us a nice tailwind for the quarter. On the volume front, you got to get underneath the headline number, look at performance by region, and look at the consumer segmentation we have in different parts of the world. Typically our developing markets is where we would see stronger volume performance. This particular quarter, we've had some headwinds in Latin America and in parts of Asia that have dampened the volume demand. But overall, we were pleased to post a positive volume number overall.
John, you mentioned something that we've been hearing from other executives as well, and that's that the high-income consumer continues to be able to spend here. Break down, are you nervous at all that the high-income consumer will pull back? And also, you introduced those mini cans, and that seems to be doing really well for you guys, too.
Well, a huge part of our strategy is to meet the consumer where they are and to offer choice, not only from a brand perspective, but from a package perspective across the many channels of business in which we operate. Higher income consumers, I think, are a little bit more resilient, a little bit more inelastic. So they're more in the business of looking for new choices on the brand, on the beverage front itself. It's at the lower end of the spectrum where I think we would be more focused in ensuring that we keep lower income consumers in our consumer base. And that's where our whole revenue growth management strategy comes into play, being able to adapt with different pack options, different absolute price points across the various channels in which we operate. So very pleased with the ongoing momentum that we see at the higher end and very focused over the coming weeks and months to stay close to that lower end consumer.
And John, on that lower side, what should we be watching for from Coca-Cola to continue to meet that customer where they are? Anything new that you all are working on to try to adapt to maybe their price sensitivity?
Yeah, you're going to have on the package front, you will continue to see different pack size options that allows our bottling partners to offer solutions at different price points. And it's really important for us to understand the consumer psyche when it comes not just to percentages, but comes to absolute numbers, and being able to reach a targeted absolute price point will be a core part of what we continue to do going forward. We also, of course, have to continue to invest behind our brands to have them be more appealing. We have a great lineup in the fourth quarter. As always, as we head into the October period, Fanta has become synonymous with Halloween. And then we, of course, will have our usual plethora of great initiatives to celebrate Christmas. And then going into 2026, we're super excited about the World Cup coming here to the United States and the engagement that allows us to bring to the many people who are very passionate about the game of football.
John, there's certainly lots of momentum that has the street excited this morning. Last time when we spoke in July, we were talking about that plan to reintroduce real cane sugar. Where are we at now with that?
Well, that plan continues to move ahead full steam. In fact, we are rolling it out as we speak in a few markets here in the US, with the plan for that to phase into many markets in the course of the next number of months. So we're excited about adding that variant to our portfolio. There's a lot of interest out there, and we look forward to seeing how it does.
When it comes to different drinks in the portfolio, I know, for example, some of the lower sugar drinks have been performing well for you. I want to ask you about a question, about a story out of the UK. There is a chicken chain called Nando's. It's based in South Africa, but they have them in the UK. And there is a story that Nando's in the UK is limiting how many soft drinks, how many Coca-Colas their customers can get at once. And it has to do with new government regulations restricting sugar consumption. How concerned are you at Coca-Cola about that? Or is it going to drive you to continue to offer some more of those lower sugar offerings?
So first of all, Nando's is a great partner of ours in South Africa and in many other markets, and we have a tremendous relationship. We're very cognizant of both consumer trends and the interests that governments have around the world to help people manage their intake. And we're very supportive of measures to do so. It doesn't prevent us from still being able to be there at the moment of purchase to offer both our customers and our consumers a range of options that fit their daily needs. And so we're actually, overall, we're pleased to be able to participate in any activity that helps people, and at the same time in activities that help us as well, because the whole essence of our strategy is to follow the consumer. And as we've seen, not just in recent quarters, but a trend going back many, many years, people are consuming less calories, consuming less sugar, and we have an innovation agenda to be there with them as they pursue that path.
Yeah, John, zero sugar was a big standout for you guys. It grew mid-single digits. If I do want to hit on quickly, value-added dairy was something that you guys are also making a big investment in. You're building this upstate facility to meet demand, especially in 2026. Is this one of many investments that you have here in the U.S. to build capacity out, or do you plan for more plants here in the U.S.?
So we're playing in a category that is on fire. The functional aspect of the Fairlife portfolio through the delivery of protein, etc., is resonating, along with the incredible taste that our team at Fairlife delivers. And yes, we see more investments on the horizon. We're keen to get the Webster plant up and running as fast as possible. It will be, I believe, the largest investment that we've ever made in a single production facility. So we are super focused on getting it working soon. But along the way will come further investments. The demand for our core portfolio continues to be very strong, and our team at Fairlife has a very exciting innovation pipeline that they're eager to get into the market as soon as possible.
John, thanks so much for joining us, and Brooke as well. Appreciate it.
Thank you very much.
We got much more markets action coming up. Stay tuned. You're watching Market Catalyst.
All right, here in the opening bid roundtable, Palace Capital Advisors founding partner and CEO Rich Mullen, and Yahoo Finance senior reporters Brooke DePalma and Inez Ferre. Rich, coming to you out of the block here, seeing a rotation into more defensive names in this market. What's the signal there for you?
I think it's a healthy rotation, quite frankly. We like to see it broadening out. Everybody's been talking about the narrowness of this market in the Mag 7. I think that probably people are maybe hedging a little bit here. There's a forgotten element in this market, and it's been some of the names, some of the more value cyclical names that we're seeing strengthen. Transportation index rallied here this past week, which was a good sign. We're seeing, positives from some of the transportation companies themselves, be it trucking and so on. So I think this is really a healthy rotation, and I think it's really kind of maybe a little broadening of the market that people are trying to find some value outside of the Mag 7.
Rich, when you say healthy, does that mean this rotation should continue?
I think, again, there's some real value here. I mean, I'm going to talk about another segment of the market here in the international, but I think right now what you're seeing is we're seeing a lot of efficiencies and productivity come out of this AI. And I think that with the specter of lower rates, which everybody's kind of banking on right now, I think you're going to see a tailwind here that's going to provide a bit of a boost. Let's not forget about some of the administration policies here, the reshoring of manufacturing, some of the other tailwinds on the stimulative side, the big, beautiful bill. This is not necessarily directed at benefiting the AI's trade at all. This is actually directed at providing a tailwind from other segments of the market.
Rich, if one wants to get more defensive here, if they share some of the sentiment or views that you just expressed, what's the better bet? Consumer staples? Everybody thinks consumer staples are this defensive investment, despite the consumer still being under pressure and earnings estimates coming down for the space, or do you rotate into gold, even considering how far it is run?
Yeah, we've never been huge gold fans, but I do think that the rotation into the cyclical sector makes a lot of sense, the value cyclicals. However, we've been actually finding a lot of value overseas, which hasn't really been talked about much, right? So earlier in the year, we made a little bit of a tactical shift into the international. People aren't talking about the fact that South Korea is up almost 50% this year. Even China is up 14, 16%. So when we talk about being defensive, I think it's more about being diversified and spreading out that risk and looking for some value in the market. Yes, it exists in the cyclical part of the value part of the market here domestically, but also I think the value trade could be put on in the international market as well.
And as I wonder if this rotation in utilities is that classic safe haven move. Utilities, of course, are now tied to the AI trade. All these AI companies sucking power out of our grid.
I was just going to mention that. I mean, I think that utilities has definitely been acting like a growth sector in a way, because it is up 21% year to date. It's outperformed the S&P 500, and you have some names in there that are definitely tied to the AI trade and the electrification of the U.S. and the upgrades of the grids, and also just an industry that also the U.S. government is also very interested in making sure that it prospers as well as part of this whole industrialization that was just talked about. So utilities has been sort of the go-to for the ancillary AI trade, and it also tends to perform better also when interest rates start moving lower as well. So it has some tailwinds.
Inez, you're also my crypto lifeline. You've been my lifeline throughout this rally this year. What are you seeing right now? Because I do find it interesting. We're seeing crypto, the bulls returning. At the same time, we have this rotation into more defensive names in the market.
Yeah, and it was a little shaky there last week because there was very much a head scratcher as to why Bitcoin was down so much. But look, you definitely have the bulls that are back in the driver's seat saying that we're starting to see, and you have to see if this will play through, but they're saying the market may be starting to see some rotation again going into Bitcoin. There's a school of thought that you will see rotation coming out of gold into Bitcoin. Gold, though investors are still buying the dip when it comes to gold, despite the massive rally that you've seen. But certainly October, right now, it looks like it could play out to be a good month for crypto if it continues at these levels.
Brooke, this consumer staples trade will be put to the test, tomorrow with Coca-Cola. And I was thinking back to what Coca-Cola CEO Ramon Laguarta told me a few weeks ago. I mean, the consumer's still under pressure. What do you think Coke may put up?
Yeah, well, right now we're looking at strong demand here in the U.S. This resilient U.S. consumer that's able to pay up those higher prices and increase the volume growth for Coca-Cola, albeit pretty low volume growth is what Wall Street is expecting. And really, we're expected to hear that not only will the U.S. be strong, but Western Europe will be strong. And similar to what we heard in previous quarters, they're expecting to see weakness in Latin America, that key China market, as well as the Middle East. And really, based upon what we heard from PepsiCo already, it's likely that we'll hear this ongoing trend of bifurcation between the high end of consumer continuing to pay up for prices and, seeking out these sort of maybe more premium drink offerings, whereas that low end consumer is really focused on the basic essentials right now.
Rich, I mentioned at the top of the show, Mag 7. We're seeing a lot of divergences within these 7 stocks. Looking at Amazon and Apple, I mean, Amazon stock has done nothing this year. It's actually down slightly. Apple has started to rally because people think the iPhone 17 is going to see a better than expected upgrade cycle. Of these two names, which one do you like?
I think from a value standpoint, Apple is kind of written off here the last year and a half or so, but that's always proved to be a bad bet. We are still very bullish on Amazon as well. I think that AWS snafu here was just a blip in what's really a long-term secular story here. And I think earnings right now for the Mag 7 across the board are going to be strong. The worry, of course, is this a little bit of a sugar high? We talked about this earlier. Is this going to spread out throughout the economy? I think it's a good point, too, that utilities are seeing some favor in this trade because they're providing that energy, and it is turning into a little bit of a growth sector. But then you have the support of the drop in interest rates across the board. So we favor Apple, love Amazon, but I think the trade's starting to broaden out here, and we're going to see some appreciation in some of the other parts of the market.
Rich, when you dissect Amazon, and you just said you love Amazon, what's more important when you open up that earnings report right now? Is it the growth rate in AWS or the growth rate in that traditional retail business?
I think primarily it's AWS because I think they're both kind of tied to some degree, but you do want to look at the consumer through that Amazon lens. I think that's kind of important. That may be another indication. We saw some language out of Best Buy, the CEO talking about this bifurcated consumer. I think that's a real issue that we have to pay some attention to, and some of that data, maybe kind of teased out through the Amazon retail numbers.
Brooke, you just caught up with Best Buy CEO, right?
I sure did, yeah. And what she really told me is this need to convince the consumer to buy right now. We're still in this environment where consumers aren't necessarily investing in a home theater or a new computer right away. They need to have a reason to splurge and spend the kind of money that goes into this latest iteration of a laptop or an iPhone or so on and so forth of AI around a device that has it, and it needs to be at the right price point. And that's really why we haven't seen the strength of Best Buy that we saw just a few years ago, especially when consumers had that stimulus money to spend. Now they've just sort of have to convince to buy right now. And that's really the trend that we're going into this holiday season with as well.
Inez, I spent the weekend configuring my new iPhone 17 Pro Max that I waited 3 weeks to get. It's a whole ordeal, but I think others seem to be with me. I mean, they might be upgrading their phone faster than people thought, in large part because of the battery. I just need it for a new battery, Inez. I mean, that's the reality of it.
Yeah, look, I mean, Wall Street was disappointed at Apple because it wasn't really within the AI trade a big leader. But look, it's back to the basics for Apple, and it's their iPhone. And now Wall Street is saying that this iPhone 17 is going to be a bigger upgrade for consumers, and the cycle for the upgrade is going to extend into 2027. So it's now back to the races with this stock. I mean, Loop Capital just put a street high of 315 on the stock with a buy rating. So definitely Wall Street is now bullish on the fact that, yes, people like you need a better battery in their phones and they are willing to upgrade.
People like me, yes, Inez, always on the go. I need a big battery. Maybe the Loop team could come over and configure my phone for me because I'm not having any luck.
Private investments in infrastructure have exploded in the past 20 years, growing to $1.5 trillion in 2024. And according to analysis from Goldman Sachs, the market could grow to $2 trillion by 2030. Let's bring in Philippe Camus. He is Goldman Sachs chairman of infrastructure at Goldman Sachs Alternatives. And this is ahead of a big alternative summit that you all are having tomorrow. So thank you so much for being here. So infrastructure spending in the last year or two has become sort of shorthand for data centers. But we're talking about the whole thing. And when you look at what's going to drive that spending through 2030, is it going to be mostly the data center and that ecosystem, or what are we talking about here, where that growth is coming from?
Well, it's interesting because data centers, it's right, when you talk about infrastructure, hijacks a lot of the attention. But infrastructure is really not static. We've been investing in this asset class for 20 years. And when we started, people thought infrastructure was all about roads and ports and airports and regulated utilities, and that was it. And there was no digital infrastructure did not exist, renewable energy did not exist. And then you fast forward to today, and when you talk about infrastructure, you think of digital and then you think of data centers. The truth is, infrastructure is really firing from every single cylinder that it represents today. You think of transport, the capital required to upgrade all of our stock of ports, roads, airports is massive. You think of energy, all of the investments for the energy transition, massive. Digital, you talked about it. Data centers, all of the energy to power the data centers. It's a huge demand for capital. And I think we are today at a point when the supply of capital is greater than it's ever been. So infrastructure as an asset class has really grown to $1.5 trillion today, coming from 50 trillion when we started. But the demand for that capital is also massive. And again, energy is a big part of it, but it's really, the demand is there for every single subsectors we invest in.
So there's a lot of demand, there's a lot of capital. It is private investment, but infrastructure as an asset class is perhaps unique in that it also needs that public component, whether it's policy, whether it's co-investment, whether it's regulation. So where are we on that front?
So one way to think about this is when you invest in infrastructure, a little bit like real estate, you have a concept of core infrastructure. Think of it as your roads and your airports and your electricity and your gas. But then you have a core plus and a value add, where you move up the risk spectrum. If you think of core, you do need government subsidies. You do need government contracts. But as you move up the risk spectrum and you go to value add, that need for subsidies, for contracts is much less important. And so there will be lots of different places that will require government help, some that will not. We tend, as an investor, to focus on value add, where we don't need government help. We like to go where we know that what we invest in works on its own, on a standalone basis, without subsidies, if you want.
So where are some of the most exciting opportunities you're seeing now in that value add piece?
So really, we see a lot of exciting opportunities. I think waste, the circular economy is a huge part of what we are focused on. When I think of waste, I think of all the biosolid, the municipal waste, but also managing that waste that used to be dumped, that now is not dumped anymore, is really kind of recycled as much as possible. Waste to energy. Waste to energy is really exciting because you both manage the waste, you recycle the waste, but you transform that waste. You reuse it. And so we do pre-consumer waste to energy here in the US, treating the waste from big corporations, people that handle the waste, transforming into biomethane gas. In Europe, we do agricultural waste to biomethane, so taking the farmers' waste and putting it into the grid. There's a huge demand for that because it's green gas, it's recycled gas, and it sells for a significant premium to where the spot price for gas is. And so that's the kind of stuff that we are really excited by. We are also big investors in the circular economy, doing what we do better. So for example, we provide modular units for education, for daycare, for construction sites, big infrastructure. So these are model units that are in timber, wood. So they recycle, you can move them. So that's the kind of stuff that, which is not that obvious, where we see really exciting opportunities, strong tailwinds, long-term contracts, good counterparties, very good unit economics. That's the kind of stuff we like.
And is most of 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. We've been seeing a mixed picture throughout the day. A lot of big earnings movers on the individual basis. Some of those are helping the Dow, namely stocks like Coca-Cola. So the Dow right now up about 327 points, about 0.7%. The S&P, though, up just about 1/5 of 1%. The Nasdaq slightly lower. And again, we're watching a lot of individual stock movers and stories today. A trio of bankruptcies and alleged fraud have sparked fears of broader issues facing regional banks. Initial red flags came from subprime auto lender Tricolor Holdings, which filed for bankruptcy last month. That was followed by the collapse of auto parts supplier First Brands Group. But just this morning, Goldman Sachs CEO David Solomon said the losses are idiosyncratic events. So let's talk more about the lending environment more broadly and the banking environment. Joining us now, Ted Swimmer, Citizens Head of Commercial Banking. Thanks for being here.
Thank you, Julie, for having me.
So surely you've been watching what's been going on in some areas of the industry. And I think ever since 2008, 2009, whether it's economists or people in the banking industry are a little bit gun shy, right? Because of the financial crisis, always looking for where the next crisis could come from. David Solomon says it's idiosyncratic. Does it feel like we're staring down the barrel of that kind of event again?
It does not. We are not involved with any of these transactions, so I'm speaking completely speculatively, but it does feel like you can't manage fraud, and this does feel like there's some element of fraud involved with this. We are involved with some of these, not these loans, but in this market, and we feel very comfortable with the book we have of our assets. It has traditionally been very safe lending. It's traditionally been asset-backed lending, and generally it's a very consistent performing asset class. So my takeaway is that these are one-off events and that the banks are not feeling any kind of pain, will not be feeling any kind of long-term pain from this. Our credit trends continue to improve and continue to feel good. We are not seeing any real weaknesses at this point. So we feel relatively good about where we are from a credit perspective in our book.
So what are you seeing in terms of on the commercial side of the business lending, both in terms of demand, And also on the sort of default or delinquency or weakness side, what's that balance looking like?
We're seeing much more demand than supply right now to lend. If you look at rates, if you look at spreads in the institutional bank market, the traditional bank market, the direct lending market, I think we're seeing tights just about all across the board in those areas. Although we're feeling M&A pick up and we're feeling the transaction formation certainly getting better, we're still in a period of time where I think there are more dollars out looking for places to lend than there are places to lend. So we continue to see the tightening of spreads throughout the whole business. I think high yield may be as tight as it's been since 2006, 2007, and investment grade bonds as tight as it's been since the late 90s. So certainly a lot of demand out there for suitable assets at the moment.
What does that reflect, the lack of being able to find those suitable assets? Why is that happening?
I think you've seen relatively depressed M&A for the last 3 or 4 years. You haven't seen the growth of new opportunities through M&A. If you look at the fact that a lot of banks, including ourselves, reported very good capital markets earnings last quarter, what you see is a majority of those on refinancing events, customers taking advantage of lower rates versus new M&A transactions driving the strength in capital markets revenues. I think you'll see that change in 2026 based on what we're feeling right now. There are a number of new M&A transactions out there. Some have been announced, some I expect will be announced in the near future. So I think we'll start seeing a better supply-demand balance in the markets in 2026, but right now it's still really the issuers are in a much stronger position than the investor, and that's resulting in tighter spreads.
And what's going to help? Is it going to be the Fed continuing to cut rates and them going lower, or what else do you need to see happen?
I think M&A is picking up because I think for the first time people believe that rates are going down and there is going to be some consistency in the cash flow. Inflation is under control, and therefore they're more comfortable taking a more medium-term, long-term view of buying a company. And I think that will drive M&A to a different level. We haven't had since 2021, 2020, when so many companies were bought at elevated multiples. Given the increase in rates, you could not get back to those multiples. Now with rates coming back down again and the confidence that rates will continue to come down, I think buyers are more willing to stretch on a multiple, and therefore the difference between the buyer and seller's expectations are narrowing, and I expect to see that result in higher M&A.
The other element that seemed to be holding things back, certainly earlier in the year, was tariffs and just the uncertainty. Not even just that they were in place, but like from one day to the next, you didn't know what they were going to be. Right. There's still a little bit of that. You never know when you're going to get derailed by a tweet. But do you find that there is more visibility in the environment also?
I don't think people are as worried about. I don't think they're. I mean, you talk about this all the time. Every day there's a new event. There's something else that's going to make people concerned. I think the buyer is getting more confident that despite there'll be noise on a day-to-day basis, over the foreseeable future, there's more confidence that where we're going as a country is to a more business-friendly, less regulated environment, which will encourage M&A to happen. So we may have these little spikes like we had with China a couple of weeks ago, but they seem to be much more short-lived, and I think the investor is more and more confident that we will not do something to overall damage the economy, which I think back in March and April, I think there was a bigger concern that we may be going down a path to damage the economy. I don't feel like the investor thinks that's the case anymore. I think they're getting, whether it's numb or more comfortable habituated with these notes, with these one-off things, and then it tends to go away after a period of a day or two.
And so are you all, on a macro basis, pretty optimistic for next year in terms of economic growth?
We are. I think we feel there's certainly some headwinds, but I think based on what we see our customers doing, based on how we see our customers performing, and based on the conversations we have, and frankly where our pipelines are shaping up for next year, we feel pretty good about economic growth in 2026.
You talked a lot about M&A, and you mentioned IPOs. Do you think, are those trends just basically going to run in parallel, that we'll also see a lift in IPOs?
I think if we continue to see the secondary market trade well for IPOs that are coming out and go, I think we will continue to see IPOs be a good source of financing for for technology, biotech companies, things of that nature. Yes, I think the answer is IPOs and equity will be a good opportunity for companies to raise funds.
Ted, let me ask you this. You seem pretty constructive across the board. What are you most worried about right now?
Look, every day there's a new piece of news. Clearly last week we were derailed by, or the regional banks were concerned about these one-off events. The unknown is what we're most concerned about. It feels very good right now, and generally when things feel really good, you worry about what's hiding behind the curtain. Yeah. I worry about rates not going down as quickly as they can. You worry about inflation spiking up. But overall, it feels like after really and it's what's hard to keep in mind is really from late 2021 to middle of 2025, we really saw a depressed M&A market, or certainly not one. We saw a lot of banks willing to lend, but not a lot of companies wanting to expand. Mm-hmm. It's been for capital markets, it's been a really bumpy last 3.5 years. It doesn't feel like that now, but it finally feels like we're getting out of those doldrums at the moment. So,
thanks for coming in.
Thanks for having me.
Appreciate it.
Appreciate the time.
We got much more markets action coming up. Stay tuned. You're watching Market Catalyst. By one estimate, monthly electricity bills have risen as much as 267% compared to 5 years ago in areas located near significant data center activity. That's according to Bloomberg. And as more data centers are expected to come online, investors are looking for ways to play the utility sector. Joining me now, Paul Zimbardo, Jefferies Managing Director of U.S. Power, Utilities, and Clean Energy Research. Paul, it's good to see you. These electricity price increases have gotten a lot of attention lately. But let's sort of take a step back and talk about the backdrop here and how much electricity demand has grown and how much of that is accounted for by the build out of data centers.
Absolutely. No, thank you for having me on. So, and to set the stage a little bit, the U.S. really has not had much electrical demand growth for the past 20 years. And fundamentally, not much has changed in the U.S. economy, maybe a little bit of reshoring besides data centers. So the data centers, by some estimates, are causing over 90% of the increase in the demand growth. We project roughly 2.5% compound annual demand growth in the U.S., and over 70% of that is from data centers. So the data center is a little bit long dated, but you are starting to see that, unfortunately, in customer bills today.
And has there been any pushback in terms of the effect this is having on electricity price? I mean, we've seen in some areas that residents have pushed back against data center construction, but is that sort of a meaningful trend as of yet?
Absolutely. And we really think it will intensify next year. So in New Jersey, they have a gubernatorial election this year coming up in a few weeks. It is one of the main topics. Both Republican and the Democrat have proposals there. And next year, there's roughly 35 gubernatorial elections. And in some of these states, it's going to be one of the big topics because you do have it increasing customer bills to varying degrees, for sure.
Is that then, for many of these utility stocks that have done very, very well, it's the best performing group of this quarter thus far, so the month to date. Is that a risk that investors now need to consider, that they, the demand that we have seen and the projections that we have seen, that they might have to be rolled back a little bit if there is significant resistance?
Yes, no, for a subset of companies, it absolutely is a risk that should be top of mind. And even more broadly, the utilities, including the power companies, are actually the best performing subsector year to date, including the independent power producers. So you do have some utilities where kind of more price takers, I call them, where you can't build the generation, versus the companies that are integrated. You can actually build the generation and you have that ability to bring the new supply. And if the data centers pay their fair share or more than their fair share, you can see more of a muted impact. So you really are seeing a bifurcation within the industry.
And so you would want you're more interested in investing in the integrated providers?
Yes, absolutely. So one of those companies is Entergy in the Gulf Coast. They're building data centers hand in hand for Google, Meta, Amazon. And they're being good corporate citizens. They're paying more than their fair share, so the impact on remaining customers is quite manageable.
Do you think that because of this pushback, that then is going to influence the agreements going forward for the hyperscalers out there, as if they are signing more so-called front-of-the-meter agreements, that they will be subsidizing the electricity so that individual residents aren't going to have to pay big increases?
Absolutely. You described it well. Or kind of make it even more transparent. The agreements are very expensive for the hyperscalers, but this concept of behind the meter, where it's very clear that you have a contract with a new piece of generating equipment. So you build a new power plant. So there's really no concerns about cross-subsidization there. Like, that seems to be the way the world is going to in 2026.
So you mentioned Entergy. As I know you don't cover some of the smaller, more experimental nuclear companies, but I do want to bring that into the conversation because some of those stocks, they are volatile, but some of them have done very, very well. We know the administration would like to see new nuclear as well. But you have some of these established companies like an Entergy or Constellation, for example, that have nuclear generation now. They're planning to bring some more nuclear generation online in some cases. And then you have the experimental guys. So how do you think about the sort of the investing case and trajectory for some of these companies?
Sure, no, happy to. So new nuclear will play a role in the future, absolutely. It just longer term. So these hyperscalers, they want power tomorrow. They want power as fast as they can get it. And unfortunately, new nuclear, aside from it being expensive, that's not a deal breaker. It's just very long term. So there's only one company, to my knowledge, that actually has NRC approval today, and the permitting is getting streamlined under President Trump. But the new nuclear projects are really 2030 plus. So it'll be part of the mix, but that's not what the hyperscalers are looking for immediately.
And so how do you think when we talk about generation, where we should look for power generation, the industry has sort of been pushing more for like an all of the above approach. Is that what economically makes most sense right now? Like sort of getting generation however you can?
Yes, and quite frankly, the hyperscalers, there's data points. They're paying multiples of what kind of the market cost is if you can get that power in the next 12 to 18 months. So there's a company, Williams, that's working with Meta. We think they're paying over $150 a megawatt hour versus kind of grid power, maybe $50. But that's because it's behind the meter, none of that cross-subsidization concern, and you get it very quickly. So if you have that offering, really it's classic supply demand. The pricing power is exponential. It's very inelastic. As you go out in time, that pricing power does decay. So there's certainly merits for that all of the above. Storage and solar can be deployed quickly versus new natural gas from the GE Vernovas of the like take a lot of time. So that's a later 2020s as well.
So you mentioned Entergy as being one of your top picks. Are there others that you think investors really have to look at here?
Yes, another one would be PPL. So that's the Kentucky core utility where you're seeing what's nice is it's not just data centers. So to the extent there's little ripples in the data center economy, you have actual reshoring, U.S. manufacturing as well there. Their Pennsylvania jurisdiction is one of the fastest growing parts of the U.S. Mid-Atlantic, admittedly from data centers, but it offers some of those defensive and offensive characteristics as well.
Paul, thanks so much. Interesting stuff. It is a big week for corporate earnings. Big names including Tesla, Netflix, Coca-Cola, Intel, and more are set to report results. Joining us for more on what to expect is Eric Clark, CIO at AccuVest and portfolio manager of the Logo ETF. Eric, thanks for being here. So as we set up for getting more into the thick of earnings season, what we heard last week from the likes of the banks by and large was positive, even though there is some concern about credit exposure at some of the banks. But given the economic backdrop and what we've been hearing, what do you think this is going to shape up to be in terms of the earnings this week?
I think earnings are going to continue to be good. I mean, stability. You never know if sometimes from some of the volatility in the markets, but I mean, earnings have been really strong and stable. Lots of good earnings per share growth. Good efficiency gains, and AI is just being rolled out to the average company. I mean, that's a 2-year type of phenomenon. So we're much more bullish than some of the short-term data indicates. We just might have a little bit of choppiness into this tariff legality that starts the first week in November.
Well, and Eric, I know that in particular, you're looking at sort of consumer spending trends and how that's going to inform earnings. So what do you think? I mean, there's a lot of talk about the sort of bifurcated economy right now, or the K-shaped economy, or whatever name you want to give to it. How then does that feed into what we're going to hear from companies?
Yeah, Julie, I mean, listen, later on, earnings for consumer companies happen a little bit later in the earnings season, so we'll hear a little bit more. But, the banks told us about spending and how consistent it's been, although consumers continue to be very choiceful in their spend. The K-shaped economy is real. I mean, some people have been kind of tightening their belts, dealing with inflation for the better part of 5 years. Walmart is serving them well, Costco, TJ Maxx, et cetera. And so there is this bifurcation. But we think in 26, we get the market broadens out, the economy starts to reaccelerate. We have Fed rate cuts coming. Inflation should kind of peak and tail off into 2026, which should give the average company a lift. And, nobody talks about it too much, but most companies have been in a bit of a rolling recession for the last couple of years. So 26, we kind of think is the reacceleration year. And we have midterm elections. The administration certainly needs to step off some of the non-growth focus and get the economy humming again. So we're pretty constructive about the rest of the market when it's been a pretty narrow market this year.
Eric, I am curious what you make of the action over the past few weeks. You talked about the volatility that we've seen, and we've seen sort of broadening in the past few weeks in that we've seen a rotation into defensive. So utilities, healthcare, staples, those have been the best performers this month, and some of the more cyclical names are down. And so is that a sign that there actually is more concern under the surface of the market than it appears?
Well, I mean, sometimes. I mean, there's volatility that's trending, and then there's volatility that isn't. And, we have this big catalyst coming up here in 2-3 weeks. And so it wouldn't shock us if we get some de-risking ahead of that. And some, we had the bank issues with some of these frauds. That always puts people back on their heels a little bit. But again, earnings are the ultimate driver of markets, and earnings are pretty good, and they're set to accelerate. And we're already seeing a lot of revisions higher. And typically what happens is revisions start to rise, and then the ISM and some of the economic data follow. And so any pullback in the markets because of this short-term headline risk, we think would be bought pretty aggressively, just simply because there's a lot of performance chasing that'll likely happen here at the end of the year.
And so where do you want to chase that performance, or where do you want to invest in this market?
Well, I mean, listen, if your base case is that the economy should reaccelerate, then some of the cyclical areas that have underperformed this year would have a much better year in 2026. So that would be consumer discretionary, some of the financials. The financials were doing exceptionally well up until about 3 weeks ago. So we think financials reaccelerate, M&A accelerates, consumer discretionary starts to perform again as the consumer starts to feel a little bit better with rate cuts. And we have Netflix on tap, tomorrow morning or tomorrow afternoon. We think Netflix is a positive surprise. Super stability in earnings, good margin expansion, implementing AI. And that's a theme we're going to hear in 26. What does the average company do with AI? How do they deploy that to throughout the company? That eventually will lead to earnings revisions, better margins, better profitability, and expanding multiples. And that's the next wave of the AI deployment. Thus far, it's just been semiconductors and the build out part. But